like to raise your hands for questions, and perhaps while we're getting the mics to you, I could just ask Professor Elroy Dimson, who's just sort of ended on that bombshell about, so I suppose what they would call it on Top Gear, that there's something slightly unhealthy about a move towards high returns. Can you just tell us a little bit more about that, and perhaps we get the others to react to that too?
Well, I think it's familiar to the finance professionals here, and that is that if bond yields go up, bond prices go down. And the observation that I've made is that when you're in conditions which are poor for bond investors, they're poor for equity investors and vice versa, over the long term. Short term, there have been periods where the correlation was a lot less clear. So what I think we should want is to see a very gradual recovery in interest rates and not a sharp move in interest rates. And of course, what's happened over the very recent past is a view about US inflation and whether the president-elect is going to have to print a bit more money. If inflation goes up, then we can expect to see interest rates going up, and that would push bond prices down, and that's what's happened very recently. This is a little bit sublime and ridiculous because I'm talking now about what's happened in a matter of hours and days at the same time as I'm telling you about centuries.
Okay. David Harrison, I mean, obviously your clients are crying out for better returns. You have to manage their expectations, well, all the time, I guess, anyway.
Yes, less so. I think that domestic investors or domestic clientele, I think that the real challenge is to get people to understand that fund managers can't make them wealthy. What the professor just said there struck a tune with me, because he said something that just towards the end there about conserving wealth rather than trying to grow it. The big thing is to get people to save, to take a certain amount of money out of their income every week and put it to one side, put it out of harm's way, which is the sort of behaviour that we're trying to engender in people, rather than hope that a fund manager will perform a minor miracle on a daily basis and make them wealthy. I think that for all that can happen, both the historical returns and the future expected returns show it's unlikely, but we still have to retire and we still have some point where we're not going to have an income. So it is much better just to put some money to one side. And that's all we're trying to do, basically. We're not trying to be clever with our investment strategies.
Let's bring in Mark Fenton-O'Creevy. We heard at the beginning about behavioural bias, I think it's called, the fact that we do tend to behave in ways on news that are not to the benefits of our portfolios. Have you any thoughts about how people in the investment world can help their clients, can help us all to understand the nature of the decisions that we're making about our money?
I think there's 2 points I'd make. I mean, the first is rather like David. It seems to me that one of the big issues is for many people is not about exactly how they invest, but the decision whether to invest or not at all. And of course, in circumstances where people look at a highly uncertain world, that can often lead to a decision not to invest because people think, well, I may as well spend it because who knows what's going to happen in a few years' time. But I think the other thing that I'd pick up on what Elroy was saying really was about, in a lower return world, how much of a proportion fees start to look like. And I think one of the big questions, as I was sitting reflecting on as I was looking at some of the charts that Elroy was showing us, was who captures the returns. So, for example, if we're talking about momentum strategies and returns to momentum strategies, one of the things that I became very familiar with at the end of the 90s as I was doing lots of research, talking to traders in investment banks, lots of traders using phrases like the trend is your friend and so on. But A lot of them were very keen on momentum strategies, but keen on momentum strategies on the basis that they were sitting in a place where they had timing advantages and better access to flow information in markets than the average punter, and that they had some confidence that they would be better than average at capturing returns to momentum strategies, which suggests that other people would then be losing in consequence. So I think one of the really important questions is who gets to capture returns, both in terms of the different kinds of strategies that work, but also in terms of the returns in funds, what proportion of returns to skill, if there is any, are being captured by fund managers, fund management firms, what proportions are being captured by advisors, and what then is left to the client in the end.
Janette, do you want to add anything to that? I know you were saying to me when we were talking about this yesterday, you know, the value of simple techniques like stop losses and everything. This is all about the individual investor taking responsibility. And of course, we've already heard how these margins are very important. If you can wipe out all your potential gains in fees, presumably this would be better if individual investors did take more responsibility for their investments and understood some of the relatively simple things they can do.
Well, it is very, very simple. How do you outperform? I outperform the 2% or whatever it is we're expecting, either through market timing or stock selection. So market timing is when you're in and out of the market. So as Elroy says, you can be tilting with your sizes and your factors and your premiums, or you can just be buying and selling at what you think is the right time. There's ample evidence that people are not very good at that. So, you know, the best thing, as Elroy said, is probably to buy and hold. The second thing is stock selection. So what happens when markets have low expected returns? And Elroy's talked primarily about bills, bonds and equities, is people look for other asset classes. So we go out on the hunt for infrastructure or, you know, hedge funds or private equity, and we go that route. Or the other route is to go for high credit risk or high market risk. So we put our money in emerging markets, or we go for high credit risk bonds. I mean, you know, there's only so many ways you can skin a cat here. So I would argue that from an individual point of view, but the advice I would give people is you're probably not very good at stock selection and you're probably not very good at market timing. So I would suggest, as David said, that to get around the market timing point, and I feel very bitter about this because I won a prize for my PhD the month before the crash in 1987. And my father said, put it all in equities, dear, it's safe. So, and then the market collapsed. So I know all about market timing. So dollar averaging or pound averaging, which is putting it in regularly, it stops you getting the peaks but also stops you getting the losses. And the way to counter stock selection risk is to diversify. And I do research into investors who invested 100 years ago, before Elroy's data actually. It goes from 1869 to 1902. And they were heavily diversified. They had no investment advisors to speak of in those days, and they knew perfectly well that diversification was a good thing, and people were writing books saying, do top-down diversification, which is even a global portfolio. And this was in 1914. Now, the problem was it was in 1914, and it didn't look particularly good after 1914, but it was quite a good strategy in the late 19th century. So diversification and dollar averaging, that's my sensible advice.
Paints a terrible picture of Professor Rutterford having to earn her living here rather than being on the beach because of that poor investment decision so long ago. Okay, another question over here.
Thank you. I'm interested in this idea of who captures the return in a low return world. I first launched into my first job in the city back in the 70s. I can remember the 70s still. And of course, one of the things then was that if you were a buy and hold investor, you were investing in paper and there was no cost to investing in paper. These days, even if you're buy and hold, you're going to incur certain amount of charges, platform charges, just for holding your electronic shares. It seems to me it's very much more difficult to escape from charges these days. And while digital innovation has made investment much more accessible, it also enables innovative ways for the financial services industry to take some of that return in charges. So I suppose my question is, does digital innovation make it, is it the wrong sort of innovation for investors?
Well, I'm not sure we can turn it back, but Elroy Dimson's shaking his head.
I just don't agree with that. I mean, if you've got minuscule amounts to invest, then the range of low-cost investments will be more limited for you. But you know, for a long time, I was chairing the Strategy Council for the Norwegian Sovereign Fund. And what I would hear time and again is, well, it's all very well for Norway, who have approaching $1 trillion in assets in their pension fund, but we can't do it. And my answer to that is the following, that what they do is very, very simple. They don't go in for this, or until very recently, they went in for nothing like this buy-to-let stuff. They bought a few bits of real estate lately. They've got about 8,000 securities in their equity portfolio and something on the side as well in their bond portfolio. And so I reached the stage where I was making some investments for my grandchildren. And I went to a product supplier, and we're being taped, so you can ask me afterwards who that is. And for about 8,000 different securities held in cap-weighted proportions, the expense ratio is truly minute, 0.1 something percent, about double the 0.06% that Norway spends, but it's very, very little. So these are opportunities that are given to us by those firms that want to specialize in ultra low cost, very simple financial products. And you can go for something that's more expensive as well. Even in the passive area, you can find lots that's more expensive. But there is choice out there, and I think this is a better world for people to invest for the long term, not a more difficult one than it was for you, I can't believe it, in the 1970s.
Any other questions?
I would just add something on that, because I think Elroy is absolutely right about the availability of low-cost products. But it seems to me that there is a real issue that's getting better, but only slowly, around transparency of costs. And I think for your average investor, understanding the contribution of fees to their overall returns and understanding the importance of what appear to be quite small differences to your average investor in terms of what these expense ratios look like, is something that most people are really not aware of. And in truth, I think there is a benefit for the financial services industry in keeping people focused on something they can't control, market returns, and keeping their attention away from the things that they perhaps can control, which is the levels of fees they're paying through the various investments.
Well, it's obviously an issue to get over to policymakers, isn't it?
The problem is the digital nature. So if you buy via a digital platform, you pay, for example, I held some index funds, and if I went direct to the insurance company that provided them, they charged me more than if I bought it through a platform. And that's the problem, is there's this really complex system where you don't know quite how you'll pay.
And it used to be better than that, because you would get fund managers who would rebate to the platform, and therefore it would be much cheaper buying on a platform than it would direct because of the rebate, because the rebate was passed on. But I think for the normal person, I mean, if we could get a show of hands here, who, for a normal advised client, a normal one, not, I was talking to an MP the other day and he was telling me about the advisor and how they charged him. And I said, do you think that advisor changed his or her behaviour because he knew you had the ear of the Chancellor? And he said, oh, I hadn't thought of that. Of course, behaviour by advisors and by people differs depending on who they're selling to. But I'd just be interested if the audience thought that, on average, for an advised portfolio, would be paying more than 1% in total fees. So hands up those who think it's more than 1%. Less than 1%? Okay, so everybody thinks it's more than 1%.
All the rest are advisors.
Yeah. Or who thinks it's more than 1.5% on average?
All in?
All in?
Yeah.
Yeah. About 2%? Okay. Yeah. It's about that. So in a world where you're getting maybe 4 or 5% in the future, 2% is going somewhere. And that's the issue. That normal people don't have the acumen that my learned colleagues have when they're asking these questions or able to source these funds. They will go to an advisor or something like that. And almost always, they're almost forced to charge these charges. And my worry is, in order to get charges down, you get a whole generation of people who think, the way to get price down is just to go to ETFs, as if that's safe, as if passives are safer than actives. They're just different. You can get cheaper actives, and you can get very cheap passives. But the more you go in that direction, I have to say, the more you're actually really on your own. So the thing that Mark had said there about our sort of campaign to try and get charges down and get them illuminated, I think is part of the sort of third part of what we're trying to say.
We had a question from the floor, and I think we've got time for just one more.
In your presentation, you demonstrated quite how substantial the return from dividends are. Do you think that we talk about stock markets in the wrong way, as in we always reflect on the FTSE 100 or the FTSE All Share or the Dow Jones? We always just talk about the price element. We never talk about the total return element. Do you think it would have more of an impact on investors if we started talking about total return indexes, so they could see in any given year that the stock market wasn't up 2%? In actual fact, once you include the dividends, it was up 6%, and that might encourage them to put a bit more money in and take the risk, rather than saying it's not worth the risk, I'll just stick it in a cash savings account.
In defence of share radio, we do talk about that quite often, though admittedly not all the time when we're giving the FTSE and all that other information. Who wants to take that one? Dividends.
Well, since you just started off, I mean, I do think referring to returns total returns is important. It is astonishing that you see comparisons of the performance of investing cash, that is cumulative interest, and also talk about equities with quite different yardsticks. If you put your money into treasury bills, I can save you a lot of time on drawing the cumulative capital appreciation. It's a horizontal line. And yet when it comes to equities, people do something that's just as daft as that. They'll look at the headline price index and won't say to themselves, that's funny, in the way that they would for cash. So there is a disjointedness there. And from your publication, you like the unit that's hosting this conference, can do a bit to help.